Hello everyone and welcome to the latest edition of Insurance Business TV. I'm your host and IB's managing editor Paul Lucas, and we make no secret of the fact here at IB that we have a big broker audience and we're constantly on the lookout for their views and opinions, ensuring their voices are heard by the wider industry. But today we're flipping things around a little. After all, no broker can thrive without a great partner. But what are the issues that matter to insurers and MGAs right now? And how can they boost their business? Well, why don't we ask them? Yes, in this special edition of IBTV, we're going to be shining the spotlight on the insurers and MGAs, from the areas they can seize upon to boost their business, through to the challenges they're facing and the trends that are emerging. And I'm delighted to say we have two fantastic guests to represent both sides of that coin. First, on the MGA side, we have Gary Hirst, President and CEO of Chess Special Risk and President of the Canadian Association of Managing General Agents. And on the insurer side, we have Peter Janzen, who is the Vice President National Mid-Market and Commercial Insurance for RSA Canada. Gents, it's a pleasure to have you both with us. Let's set the scene here. It is a hardening market. We're in a recovery period from COVID with a potential third wave looming. So with all of that factored in, where is the greatest appetite for insurers and MGAs at the moment? What coverage areas are you focusing on? Peter, I'll come to you first. I know you can't speak for the entire insurance market. That's pretty vast, but give us some insights on what you're seeing.
I think you're right. I think you touched on it. We are at a very, very interesting moment in time. We've got a lot of moving parts at the moment. And I think to start, it might be worthwhile to lay a little bit of context. Firstly, there is a lot of pressure on the underwriting community and the insurance companies to deliver a strong profit. Obviously, we've got the combined pressure of low interest rates and strong shareholder expectations. And so what that is creating is a market that remains very, very tight. Now, I wouldn't say that's uniformly across the board. There are differences depending on the products that you're looking at. But if you were to dial in on the property market, certain segments remain extremely challenged and stressed for capacity. There's the common ones that we know, such as the residential real estate market, but also niche lines where you have fewer players participating, the energy market, for instance, and that's creating a market where you've got strong rate increases, but also a demand for capacity. And we're seeing the same thing on the liability side of the market as well. In addition to that, we've got the reinsurance pressure where our cost of capacity is going up also. So it is creating a situation where we view the hard market persisting. All that being said, we are starting to show signs of softening, and we also have a growing appetite in the commercial fleet space. And I'm referring here to the standard domestic fleets where we've got a mix of heavy and light commercial vehicles. Less so in the hazardous side. We still find that the transportation market and sand and gravel hauling, things like that, remains fairly tight. But on your standard fleet business, we are seeing that the market is beginning to soften and that there is a fair amount of demand across the board on the insurer side of the business. The impact of that when we're looking at renewals is increased competition. The competition is coming hard at our good accounts as well as on any new business. And the ability to achieve rate increases, there's less reception in the market for that as well. And I think that there's a lot of things that are driving that. You know, in general, the insurance market is doing well on the auto line. I think there is a COVID impact there. We are seeing reduced frequency by the fact that more people are staying at home and working from home. But that might be an artificial inflation of short-term improved results. But needless to say, we are seeing demand go up for the fleet space and an increase of capacity. And I think we're seeing that across the board. At RSA, we feel like we're well positioned. We do have a strong team focused on risk, quality, and engineering. We invest heavily in talent. We have a dedicated team focused on the auto line. So we do treat auto as a core line rather than a support to our property and casualty business. And we're setting aggressive goals to grow in that space. And so far, fingers crossed, in 2021, we're achieving them. So we are seeing RSA's appetite for fleet increasing along with many of our competitors as well.
So Gary, Peter's talking there about a sort of a spike in interest in the fleet segment. Give us some insights into how things are looking on the MGA side. Is it vastly different or much the same? I'm guessing there's a real focus on niche markets here.
It is a very broad-ranging question, and something that we could discuss infinitum. Looking at the MGA area, MGAs traditionally are not involved in auto or motor. There's fairly strict legislation in Canada that governs what insurers can and cannot do. So from a chess perspective, auto or motor business is not something that we're particularly focused in on. In terms of coverage areas that we're seeing, as Peter mentioned, there is a flight to technical underwriting profit that the insurers are now strictly adhering to. That has meant that we're seeing, big increases in pricing coming through from standard market carriers. The list of excluded classes are getting longer and longer. And that's been a significant change in the marketplace in terms of the way MGAs are perceived by insurance brokers. The brokers are pretty desperate for capacity. Where they've traditionally been supported by a standard market carrier, maybe the appetite has dropped, and there's various classes of property, construction, or liability that is being dropped. We're seeing that those businesses coming to us. We have the capability of providing capacity in both property, liability, and construction industries to the tune of over 1,200 industry codes. Canadian market is governed by industry codes, and I think there's something like 1,700 in total, and we're deploying capacity in 1,200 of those codes. So we're seeing a substantial improvement actually in the type of business. And the broker's perception, I hope, of an MGA is improving, in that we're not being considered as just a substandard market, or a market that is looking at the really difficult classes of insurance. And we're now actually seeing substantial improvement in our risk selection and our risk type, because now we're able to access the business that is falling off the table of the standard insurer and into the lap of the MGA.
Of course, there is an obvious flip side to this question too, as well, isn't there? And that being, what are the areas that insurers and MGAs are perhaps steering away from and not wishing to sell policies within? I'd love your insights, and maybe if you can, tell us the reasons why they're making those moves. So Gary, I'll stick with you for this one.
Well, as I say, we're not a market for auto, motor. It has been a very difficult area for everyone over the last 4 or 5 years. Losses have been particularly difficult. Proximity to the USA and having incidents over the border in the USA provide not only difficulty in assessing claims, but also whether or not you're actually licensed to operate in those areas. we're dictated to by the carriers that we represent, and I think at Chess we've been very lucky to be supported for a very long time by a number of well-known insurers in the MGA market space. So hence the reason why I think we've still got a very broad appetite. However, there are still the difficult classes, and these difficult classes have really been the domain of the MGA arena, not necessarily something being considered by standard markets. So those areas of difficulty still seem to be recreational type businesses, hospitality, adult entertainment. They still have really difficult areas. And there's some areas of contractor type classes. Roofing in particular deserves a mention. That continues to be extremely difficult. Obviously, sitting here in Canada, even though we've got the sun shining now and it's 25 degrees, we've only had 25 degrees for about 4 days because we've still been locked in winter, and winter brings with it cold temperatures, snow and ice, and snow removal. And in the past, you know, companies have been opportunistic in going into snow removal because, you know, the grass doesn't need cutting and the hedges don't need trimming. And that type of opportunistic entrepreneur is finding it difficult to buy liability insurance, for instance, for snow removal. Underwriting those classes has become a lot more technical, and I'm afraid that the entrepreneurs that own those types of businesses that perhaps haven't been focused on risk management are finding it difficult to buy insurance. So they're really the areas that we're seeing the brokers having difficulty in putting capacity together and being able to represent their clients.
So Peter, obviously, Gary's outlined quite a number of lines of business there that are perhaps struggling a little bit. And he also mentioned earlier, of course, that insurers perhaps, you know, there are some areas of business that they're moving away from, perhaps some business falling into the laps of the MGA. Give us your perspective here. Are you seeing insurers move away from any key markets?
I think Gary also made some great points in the first question, that this is another topic you could take in a variety of different directions. But the classes that he touched on that are challenging for the brokers to market, I would echo all of those sentiments there, particularly on the snow removal. It's a real challenge. When I look at RSA at the moment, I think that we have been consistent in the medium and short term on our appetite. And so, you know, if the question is, are we drastically changing our appetite right now and looking to exit lines that we were previously in, the answer would generally be no. But that doesn't mean that we don't continuously look for ways to increase our profitability in a variety of ways. I would expect the same from Gary and any other person deploying capacity. And my view is that there's a couple ways that companies try and accomplish this. I think the first thing that a company and insurer would look at, I know RSA does, is we can spend a lot of time looking at data to guide us to where we want to play and where we're making money. Probably more importantly, where we're losing money, and also looking at pricing in the market and seeing where it's receptive and where we think we can get adequate price in order to achieve our profitability goals. And then we would obviously then move to adjust our marketing efforts and build a strategy around how to grow or shrink in that given space. And so what that can result in is a lot of instances where companies are jumping in and out of a segment, whether that be hospitality or real estate or what have you, or perhaps there's an emerging market. So something like cannabis, which has popped up in the last 5 years, and cyber and a few other products that have emerged recently. But I think this type of in and out approach can pose challenges. I think firstly, we run a risk where the data can be misleading. Working on the company side for a while, I can tell you the data isn't always perfect, and a variety of factors can lead you down a road that may not be the wise decision. There's always that challenge in discerning correlation versus causation. And then even when the data is perfect, what can happen is a lot of the insurance companies end up building the exact same strategy and going out to market with the exact same appetite. And this is where you see, as Gary mentioned, a lot of business falling into the laps of MGAs when everyone's basically targeting the same type of business and then steering clear of the balance. And so recently at RSA, we've pivoted and we've decided to go what I like to think is a level deeper, really focusing on the customer, getting back to old school underwriting, really focusing on risk quality, really heavily investing in our engineers, in our loss control team, and really understanding, irrespective of segment and class, is this a good risk? Really focusing on the COPE and understanding what is and isn't driving our claims, and then the all-important topic of pricing. And we are employing actuaries to help us do that, but ensuring you've got the right rate to do that is important. And of course, this requires expertise and means that you need to invest in the right people. If you're going to play in the energy segment, for instance, you need to have the right talent to focus on that line of business and focus on it. But I think if you go about it in a smart way and you focus on risk quality, that is the best way to achieve your profit goals. Conversely, staying away from those types of businesses that might cause you profitability challenges down the road. So I hope you don't feel, Paul, like I've dodged your question. I don't feel comfortable necessarily listing a segment, but rather would say that our strategy is to focus on risk quality, look at the actual customer itself, and making sure we're making a good decision on that level. And I think that is going to be our kind of go forward approach to making sure we're building a sustainable portfolio.
I don't think you dodged the question, don't worry. But I will say that you mentioned, of course, about rate there. And of course, as I talked about at the top, we're in a hardening market. There's COVID. I guess there's a huge technological push going on right now as well. So much is happening this year. Just while I'm with you, Peter, tell us what you see as the biggest shifts that have occurred in the market during this time.
I think you, even in your preamble, you touched on a variety of things. And depending on how far back we go here, there's a lot to talk about. Obviously, there's COVID, which posed unique challenges in the last 18 months. Learning how to deal in a virtual work environment, which is a staff engagement play that we needed to reconcile, but also broker engagement. How do we market and how do we ensure we're engaging with brokers in order to ensure that we're building the pipeline of business and building our relationships. So COVID was obviously a big shift. The market conditions, like you said, and I feel like I've touched on already, the hard market is still with us. There are spots where we're seeing some light softening. I don't know if the brokers would necessarily agree that they're feeling the softening at the moment, but the hard market is certainly still with us. And there's also the rate fatigue on the client side after going into perhaps your third year of seeing a rate increase. But I think the more pressing change that's happened, it comes in the form of consolidation. Obviously, on the insurance company side, I work at RSA, and all signs point to the fact that we will be acquired by Intact shortly, and so there is consolidation on the carrier side as well. I feel like the carrier side still remains very unconsolidated, and so it's likely in the next 10 years we could see more of that happening. And everything you read from the regulators would say that there is appetite for further consolidation there. But personally, I feel the bigger story is on the broker consolidation, which we've seen occurring at a record pace in the last few years, and it really is changing the dynamic between an insurance company and the broker. When brokers get to a certain size and insurance companies get to a certain size, it really changes the dynamic, and there's a real dependence going both ways, that the partnership is strong and that we are, we're dealing with all the various complexities that can happen when you've got a huge personal lines volume, a huge commercial lines volume, a specialty lines volume. All of these various parts of the portfolio now exist at such a large level that it really changes the insurer-broker dynamic. And the second shift I think we're seeing is the boutique broker model is getting impacted by national consolidation, and you're seeing big national players take the place of where there would be more boutique and privately owned brokerages out there to provide solutions to client. And I think brokers are going to have to focus on maintaining their culture and ensuring that there remains a sales culture, and that the individuals that brought value at that boutique level are going to come over to a big company environment and still succeed. And we all know what that brings with additional governance and more structure and more managerial roles, and that transition is going to be interesting to watch unfold over the next few years. So I think broadly, the broker consolidation is what I feel is really the big change in the last 6 months or so. The impact, it remains unknown. I think this story is very much so still being told. I foresee, there's going to be a real value placed on talent and talent acquisition, and ensuring that the bigger broker gets that they're retaining the right people, and if they want to focus in a certain area, they have the right expertise to do that. And then the interesting thing will there be a reaction to this action, which would perhaps take the form of more boutique, smaller brokerages emerging in the industry to take the place of the private brokerages that may have been acquired recently, and what impact that could have. So I think we're at a really interesting time on that basis, and I'm interested to see how the next 5-10 years play out on that basis.
Gary, talk to us a little bit about what that impact has had on the MGA landscape, and talk to us generally about what sort of changes that you're seeing recently.
Again, a very broad subject, and I'm going to echo a number of comments that Peter's mentioned. I think I can pinpoint when the hard market hit us, and that is August 2019, when there was the start of a shift of appetite change by our supporting markets. 2020 saw a number of Lloyd's syndicates do their internal reviews. Lloyd's has previously been the largest commercial insurer in Canada, even larger than Intact prior to RSA acquisition, although Intact still continues to be the largest insurer overall. And unfortunately, we've all been impacted by COVID. COVID has driven a number of unexpected claims into the market. These are claims that are valid, perhaps, but have not previously been priced for. So although coverage appears to be in place in a number of insurers' policy wordings, it wasn't previously priced. So the claims impact has certainly perpetuated the flight to technical underwriting profit. The lack of investment income, it doesn't just affect insurers, but it does affect the larger brokers, and consolidation is well underway. That in turn, as Peter alluded to, creates a lot of fallout. By the young professionals in those organizations that feel that perhaps another glass ceiling's been inserted on top of them, more management structure, etc., and their aspirations of being a leader in the broker community get squashed. So those individuals then fall out and perhaps set up the boutique broker that Peter was referring to. You then have issues when you're in that situation of trying to get a contract to work with an insurer, and that's where the MGAs come into their own there, because we're not quite as rigid in terms of contractual agreements and income projections. We can then see, the insurers looking to own their distribution, and there's been a number of very large acquisitions taken place by insurers into the broker community. So where perhaps there will be regulators asking questions about market share and market dominance as an insurer, you can perhaps sidestep that by owning your distribution and making sure that the brokers are actually still pumping the business through to you. A lot of really interesting dynamics, but from the point of view of the MGA community, as you mentioned earlier, I am the current president of Canada's MGA Association. We've seen a huge shift in premiums coming into the MGA community. Prior to the hard market and prior COVID, etc., MGAs accounted for probably about 20% of the gross written premiums in the Canadian marketplace. A lot of that support coming from Lloyd's. We're now seeing that the importance of the MGA community is now rising to perhaps 40% of the gross written premiums available in the marketplace. You look at Quebec. Quebec is a province that has been under pressure for many, many years. You're looking at the dominance of certain insurers in that province. You're looking at a number of insurers now going direct to client base, which puts even more pressure on the brokers up there. And I was in Quebec last week talking to a couple of brokers, all socially distanced, of course. But you know, we were seeing that well over 50% of their portfolio is now placed with MGAs. That's what we're seeing at the moment as being the biggest influences in the current market.
Sounds like MGAs are really seizing on the opportunity here. And of course, with changes occurring, this does bring with it a lot of challenges as well. So Gary, I know that you're loving these broad questions. I'm going to throw another one at you right now. What would you pinpoint as the greatest challenge then that the MGAs are facing in the market right now?
The biggest issues for us, as I'm sure for our sort of colleagues in the insurance companies, is basic workflow management. And it really does come back to basics of being able to provide the quality service that as an organization you want to provide. And you know, a lot of the brokers and clients have learned to expect from organizations. And what I mean by workflow management is literally the volumes that are flying around the industry at the moment. We're receiving hundreds of new submissions every single day. These are risks that, as a company, we try to answer, try to quote, or try to respond to within a period of 48 hours. So we've seen the volume of submissions, whether it is by email or telephone, via our website, etc., triple over the last 8 months. So trying to provide that quality level of response is particularly difficult, and that I'm afraid is not just driven by the fact that markets are declining business and, you know, computer says no type of response, but it's also a response to the fact that insureds are not liking the answers that they're getting, either from an MGA or from an insurer. And there is a tightening of underwriting conditions. It may well be a risk that is in appetite, but you know, the deductible's wrong, or maybe the coverage is a bit too broad, or maybe the deductible level is at the wrong level. And in the flight to technical underwriting profit, you are required to make these changes. And it is, a great concern because, of course, you've got clients that are being impacted by the current economic breakdown. They're finding it tough to earn a living. We're trying to make a technical underwriting profit. These prices are going back out into the market. There's lots of wailing and gnashing of teeth when that's received, and as a result, the amount of what we call shopping has increased the volumes that we're seeing. So that is, the biggest challenge that I find certainly at Chess we're experiencing.
Peter, some great points made by Gary there, some teeth gnashing along the way. Do you see insurers' challenges as being very similar?
I think that was well said with Gary. I would agree. Not only are the amount of submissions coming in increasing, but also the mix of business that you're getting, and the amount of which would potentially before have been within appetite versus outside of appetite. The business that's going to market lately is usually going to market for a reason, and so that obviously adds to the workflow challenges that can exist there. So I would agree with Gary. In addition to that, it's been a big year. There's been a lot of different challenges. If I was being honest, we've talked about many of them. The hard market and COVID, amongst just kind of the regular challenges of this industry, which is not an easy day most days. So it's been an interesting year, and a lot of learning is coming from it. But if I were to focus on one of them now, I wanted to pick one that would be applicable across many different types of businesses. And so if I think there's a challenge in the industry in general, it would probably be around talent. I think that we're at a bit of a tipping point right now as an industry about how we want to recruit and retain and develop key talent so that we're set up for the long term. And I think about that problem on a number of levels. Firstly, I think if you were to look at new talent coming into the industry, I know if you were to walk into most business schools in Canada right now, there'd be a finance path, a accounting path, a consulting path, a marketing path. There is not typically an insurance path. And so it isn't like there's a lot of 20-year-olds out there, I think, envisioning themselves as an insurance broker or an underwriter down the line, although it is a great career. But even if there was a big group of young people looking to get in, I think the amount of opportunity and the amount of entry-level roles is increasingly rare. The roles that typically people would have started at an insurance company, whether that's working as a technical assistant or keying policies into the system, just so you could learn the basics, it's getting replaced by technology in many cases, even offshore with certain companies as well. So I think there's just a lack of opportunity for young people to enter the business. Beyond that, training programs. I know I personally got started at Lombard down Northbridge's training program with 13 other recent graduates, and that was a great way to start in the industry. And today, those are less common than they were before. And I think that we may, realize short-term expense gains, but long-term pain with there being less talent in the industry. So there's a question: do we have enough high potential talent entering this business to sustain it, across generations? And then beyond bringing new talent into the industry, I think we need to think about how we recruit and we retain our skilled labor. Technical expertise, marketing prowess, any kind of leadership skills in combination with those first two, that's extremely desirable right now. And that's across the board, whether it's an MGA, a broker, or an insurance company. And so there's a real talent game. And I think the industry needs to kind of look at itself in the mirror and say, are we doing enough to build that out? Whereas you look at other financial services businesses like finance, accounting, there's a lot of formal education opportunity. Now we do have, the CIP designations and things like that help, but just ensuring that infrastructure stays there in the long run. And then if you do secure that really strong talent, which is essential if you want to be a player in the larger commercial space, the impact of COVID's creating a real challenge around engagement. As much as you can give the basic tools and the environment to work and operate and select risks and price accounts, people want to have fun at work. And when you're working from home and you're in your dining room table and your dog's running around, maybe you get some kids screaming at you, building that team culture is a real challenge in a virtual setting, and how the insurance industry engages with its people and ensures that we don't lose that spirit of team is very important. And going back to one of my first points, imagine being that 21-year-old or 22-year-old coming into the industry for the first time. In a traditional setting, you'd sit at your cubicle and you'd be surrounded by expertise, other people around you who could train you and teach you, and you could turn your chair around and ask questions. All of that is gone right now as we try and onboard people in a virtual setting. And so ensuring that we have the right formal structure in place to bring those people on the journey is going to be an investment today, but I think we'll get the returns of that later. So again, I think there's solutions to these challenges, but I do think ensuring that there's development programs to nurture top talent, ensuring that we're allowing our talent to make the right decisions and they're enabled to do their jobs appropriately and they have the right tools. And also given the opportunity to enter the industry is going to be very, very important. I know at RSA, one of the things that we have started doing, which I think will be more commonplace as we go forward, is being less geographically bound with our hiring. So before, if we lost an underwriter in our Ontario region, we would typically look to hire them in Ontario. Well, now we can post nationally, and we can get access to talent in Vancouver or Montreal or Halifax. And so what that allows us to do is open up our talent pool and ensure people have the opportunity to add value from wherever they may sit.
The last year has really shown us all that remote working really can work. And on top of that, great points about talent, of course. So many young people that I talk to seem to be put off just by the word insurance. When you actually explain what the job can involve, all the different aspects to it, I think it becomes a lot more interesting to them. But finally, while I have you both, if you can, I'd love you to give us a little insight into where you see the market heading. I know there are no guarantees. Things are constantly changing. I think the last year has certainly shown that. But what are your thoughts on the emerging trends for the industry that we should be mindful of going forward? Gary, why don't you kick things off for us?
I think we're seeing substantial changes in software and technical ways of taking human error away from a lot of the underwriting results. That also has a byproduct of improving service. I can remember starting my insurance career in the London market, where a client would be lucky to get a policy, 12 months after the policy had expired. And I'm running around trying to get these things agreed and sent out. That has come back a long way to now being able to actually invoice and issue a policy within sort of 30 minutes of binding a piece of business, if that's required. And those Friday afternoon specials do still fly around the marketplace. So and we're forever grateful for those. We're seeing a lot of innovation in capacity. As Peter alluded to earlier, there are a lot of pressures on insurers from their treaty protection providers. We're seeing capacity innovation in a different way. There's a lot of talk at the moment about MGAs engaging with reinsurers as MGAs also seek additional capacity avenues. That comes with its own complexities, of course, because there are very strict licensing rules and regulations in Canada as to who can insure a Canadian insurance policy and who can't. But there are certainly structures available that are slowly pulling more capacity into the marketplace. As the current trend for underwriting profit and tougher underwriting conditions continue, there will be more entrants coming into the market. We're already seeing that in the London market with a couple of new entrants coming in with $2 to $5 billion worth of capacity. The new capacity, luckily, is not pulling down rates at the moment, and it is the basic supply and demand scenario. So those new entrants are being able to come in at the higher levels of pricing, which is frankly good for all of us. Lastly, I would say product innovation. Here at Chess, we are launching 2 new products later this year, which have not been done in Canada before, and that's as much as I would want to say at the moment. But we're quite excited by that because the focus on by everybody over the last 18 months has been on, working from home and trying to find markets and all the hard work that goes into that. And, to hopefully introduce some levity of new ideas will help to, bring a bit of enjoyment back into, the insurance industry.
We'll look forward to those innovations. We hope that you will, our audience, that you will read about them first on Insurance Business Canada, of course. Peter, if I can switch across to you, what do you see in your crystal ball?
As we've alluded to with a number of these questions, you could take this in a variety of different directions. But I think when I look at what we're seeing and what I then could logically see continuing into the future. And I think Gary alluded to it as well with the the emergence of more technology entering the business. But it would be the growing distinction between in the commercial side of the business, the transactional policy versus the non-transactional policy, and the different business models that are required on the insurance company side to manage that business. I think going forward, insurers are going to need to decide where they want to play, and then build a bespoke, appropriate strategy in order to succeed in it, and ensure they're properly positioned in order to manage that. And as an example, I would look at what's happened recently in the industry around the SME commercial space, or the small business commercial space. Historically, SME business would have been handled in a very traditional method, in a standard underwriting model, mid-market light, you might call it, where there would be slight tweaks to a standard underwriting process where you'd be handling more complex business, but there'd be some efficiencies built in, a few low-touch measures taken in order to make sure you're handling that business in a quicker fashion. But today we're seeing that model shift substantially, with an underpinning of expense management being driven into that area of the business. So things like technology taking the form of portals. We're seeing more portals enter the business where brokers are able to solicit a quote and bind it on the spot. Where could this go? Who knows? This could be take the form of what's going on in the personal insurance market, where there's a centralized method of getting quotes in the small business space online. We're going to see more and more emphasis on pricing excellence in that space, as people get really fine-tuned on the price that should be charged for these packages, and then they can build up the volume in order to achieve profit at scale. And lastly as well, operational schemes to maximize the efficiencies. Again, this is already taking place in the personal lines models of most insurance companies. If you were to walk onto those floors, it's very operational, and bringing that discipline into small commercial will be something that we see much more of going forward. And those changes require a different mindset than what insurers traditionally have taken to managing their business, a different skill set, and most importantly, when we talk about technology, an investment as well. And so when you're spending money, that's a big commitment, a long-term commitment in the insurance company side. It takes a long time to develop a tool and implement it. And so the decision will have to be made on the part of the insurers. Are we gonna play that game? And what you need to recognize is there's a potential you're getting into an arms race with those larger companies that are very committed in that sector, and making sure that you're staying at least on a level playing field with respect to the efficiencies that they're going to be realizing through these changes. Conversely, if you make the decision you want to play in a large, specialized, specialty risk managed portion, or in niche lines in the insurance business, brokers are looking for true partners. They're not looking for capacity. They're looking for an individual that they can talk to and talk through a risk, perhaps consult, get some technical expertise, really a partnership approach to placing some of these more complex accounts. And that requires less infrastructure than SME, but more of an emphasis on talent, more emphasis on having technical experts who, I call them unicorns, those that are able to understand the risk, but also manage the broker well. They've got that marketing gene in them as well to manage that relationship. And so you need to invest heavily in your people, ensure you're recruiting, retaining them, building an environment that they want to succeed in, but also developing, junior talent into those roles as well. So I think, just depending on what the vision is for a company, there's going to need to be an acknowledgement that there's two distinct models developing, whereas before they were closer together, deciding which ones you want to play in and then placing their chips accordingly so that you're set up for the long term. I think the big companies may be able to do both, but more small, mid-sized firms will have to pick and make sure that where they play, they succeed.
Some brilliant points made there. A lot of food for thought for everybody watching. My huge thanks to Peter and to Gary for joining us today. And to all of you watching, we hope that we've given you an insight into what insurers and MGAs that you perhaps collaborate with on a day-to-day basis, what they are actually dealing with themselves. We've had two great guests today, and we promise you that we'll have many more in the future. So join us next time here on Insurance Business TV.